This session is concerned with venture capital, and we're going to start by looking at the definition of venture capital. Now, this is an important source of finance for new companies, particularly innovative companies, perhaps companies introducing a new product or perhaps varying their production technique. So traditional sources of finance, perhaps the banking system, is not necessarily suitable for those companies because of the higher degree of risk, or because there is a general lack of knowledge about what is happening within the company or what the company is doing, or perhaps even the direction it's been taken in. So venture capital solves an important source of finance for economic development, for business development, and it enables innovative companies to pursue projects which perhaps otherwise would have not seen the light of day. So generally speaking, innovative companies engage in high risk investments, and with the higher risk they require specialist sources of finance. Venture capital is used to finance these investments, and this is raised in the capital market by specialist venture capitalist companies. So venture capitalists buy shares or convertible bonds in the company. In other words, the venture capitalists take a stake in the company. They supply the finance, but in return they take a share of the business. They allow time for the company to expand and develop, and then they liquidate their investment. Obviously, if the business is highly successful, the share they've taken will have appreciated in value and they will make a profit. Of course, it's also possible that the company will not prosper. Perhaps the idea was not as good as people thought, or whatever, something happens in the market, something adverse, so that the venture capitalists would incur a loss. So they are taking a risk, but they're doing it in this particular form. They are particularly interested in innovative SMEs, small to medium-sized enterprises. And they are particularly interested in very rapid growth rates. Generally speaking, they like to, once they've made a decision, to put their money in, take a stake in the business, and get their money back. The payback period is short. Get the money back, get their investment back as fast as possible. That's the preferred route. So let's look at the issues here with the finance. Well, we have equity financing, buying a share in the business, and its drawbacks. So taking an equity share means losing part of the ownership of the business. So the people who set up the business in order to get the finance to get it started must accept loss of some aspect of the business, some control perhaps of the business. So the business owners lose part control of the business at least. Generally speaking, the shares are not secured. Generally speaking, the venture capitalists, if they like the idea, will issue the investment required on the basis of the idea. Perhaps they like the idea, whereas perhaps other forms of finance may require the owners of the business to put their house or some personal assets to secure the investment. But they may require a directorship. They might want to sit on the board to make sure that what was agreed is being pursued. So they want to know what's happening on the inside. Shares are unlike a loan in that no interest has to be paid. So generally speaking, equity financing, there is no interest payment. What happens is there is a dividend. The company will issue a sum of money per share, perhaps every year or every given time period. And that means the business has more flexibility. It's not honor bound to make a fixed payment at a certain period of time. It has got flexibility about when it issues the dividend and the extent of the dividend. Of course, if the venture capitalists were to have a director on the board, the company's expenditure will be fully scrutinized, and it'll be obvious to the venture capitalists what the policy of the business is and how well the directors are meeting their commitments and what they promised at the outset. The venture capitalists will bring experience and a fresh perspective to the business. Well, venture capitalists have wide experience of startup businesses and new and innovative businesses. So it is a good thing that the venture capitalists are involved in the business. But as I said at the outset, the profits must be shared with the venture capitalists. We don't get something for nothing. So the business is getting the investment, but it must share the prosperity with the venture capitalists. Now, the types of venture capital. Well, venture capitalist funds may specialize in certain sectors of activity. For example, it's common to have venture capitalists who have expertise in, say, biotechnology or information technology or whatever, some new form of scientific application, commercial scientific application. So venture capitalists tend to go for those type of ventures more readily. They may also become involved at different stages of the development. For example, they may wait to see evidence of growth and also evidence of commitment by the owners before they become involved. It doesn't mean they're going to start immediately. Somebody gets an idea, they go to the venture capitalists, and the venture capitalists give the money to, or the investment to start up. That may not happen. It may be they want to see commitment on the part of the people who are initiating the business, starting up the business. They may wish to see how well it's doing after a set period of time and then become involved. There are different types of venture capital funding, as I said. One type is seed finance. This form of finance is provided to research and to assess and develop an initial concept before the business has reached even the startup phase. Now, with seed finance, this is genuinely entrepreneurial. This is when the venture capitalists put up the cash right at the outset. They put up the investment right at the outset so the idea can be developed and ironed out. So they're involved right from the start. Startup finance, this is for companies who have got the idea but they need to get it into the market, and they need to have a presence in the market. They need to start trading, and they need the funds necessary to do that, perhaps to engage in marketing or to employ specialist workers or buy specialist machinery or whatever. So the startup finance stage would be next. The business may, in the early stage of setup, or it may be that it's not traded commercially. I mean, it is entirely up to the venture capitalists as to which direction to move in. Generally speaking, as I said earlier, venture capitalists like to see some commitment by the owners and also like to see how well or how poorly the product is doing in the market before they become involved. Early stage financing. This may be available to companies that have completed the product development stage and now need to commercialize the product. It fits in just after the startup phase. Early stage financing is a company who has developed the product, has brought the product to the market, but needs to have wider exposure of the product, needs to engage perhaps in extensive marketing, or needs to push the product more vigorously and needs finance to do that. So it's early stage financing. It's tooling up to capitalize on what was foreseen in the business plan. This stage of the business generally speaking will not be generating a profit, or will not be generating much of a profit. So early stage financing it's the business is in operation, but it's not doing very well. It's just at the startup phase. Next is expansion or development finance. This is a source of finance for the growth and expansion of a currently profitable company. So the company exists, it's making a profit, but it really needs to expand, perhaps into an overseas market or into a different segment of the market. Perhaps it needs to, again, innovate the product, slight modifications to the product to make it suitable in a different segment, something like that. So it needs to expand, and it needs the finance to do so. Venture capitalists could be involved with that. The capital raised through this form of finance may be used to increase productive capacity, engage in more marketing, as I said, or provide additional working capital. The next type is known as mezzanine bridge or bridge finance. Now, this type of finance is used in times of transition from privately owned to publicly owned. This is, for example, a private company becoming a public company. So it's floating on the stock exchange. It's opening up its share register, if you like, to the public. It has to go through a lot of scrutiny on the part of the stock exchange, and it has to be approved and so on and so on. But in that transitional period, moving from private to public requires a significant amount of investment to ensure, not least, that there are investors in the market, generally in the market, wider in the market, who are willing to put up the cash to buy the shares so that the flotation on the market is successful. There are many high-level flotations of this type, Facebook, but it happens in all types, different types of business. Next, management buyouts. Well, this finance provides the current operating management the facility to acquire the existing product line or the business. Sometimes the owners, for whatever reason, decide to disengage with the business, to move away from the business, and management who have an expertise in the business and who can see the potential of the business may wish to buy it out, buy it from the owners. And in this case, a management buyout may involve venture capitalists who may finance it and get the management involved, up and running in the, not just the management of the business, but the ownership of the business. It's also possible to have a management buy-in. This form of finance is aimed at a manager or group of managers from outside the company to buy into the company. Now, so it may mean there's a group of managers in company A who know about company B, and company B perhaps is in their area, their particular market, and company B is up for sale. So the management in company A might try to buy company B and set themselves up as a business there. What they're doing in effect is bringing their management skills to bear and moving across into a different business. But in order to do so, they may need finance, and that's where venture capital would again be used. So the venture capitalists are primarily interested in the growth of the business and thereby the growth of the value of their investment. The venture capitalists are not doing it for fun, not doing it out of charity. They're doing this to make a profit. The venture capitalists will gauge the success or failure of the investment with reference to various criteria, various means. For example, investment appraisal may be used to assess the return on the investment. It's more than likely various investment appraisal techniques will be used. These are the subject of other videos. For example, the internal rate of return is one such measure, and that may be used. The internal rate of return is a very complicated one to use. They may use the net present value as an alternative, or they may simply use a payback method of investment appraisal. How long does it take them to get back their initial investment at current rates of profit? So the internal rate of return is one such measure, but there are others. And as I said, the internal rate of return, I should say, is a fairly complicated investment appraisal technique. Generally speaking, the investor will set a benchmark rate of return using this technique and compare it with the internal rate of return. So the investor might say, currently the interest rate in the market is 5%. Therefore, if the return on this business will give a return of is higher than that, it gives, let's say, 7%, then it may be worth investing in the business. So if the interest rate is 5% and they can get a return on the investment of 7 or 10%, it's worth investing. Calculating that is fairly complex. It could be used to rank various investments, and it is possible to imagine venture capitalists having a whole range of investment opportunities, and they rank them according to some investment appraisal technique to see which ones they should go with, which one gives them the best rate of return. The market potential of the project will determine the potential return on the investment. So looking at the internal rate of return or any investment appraisal technique, what they're really doing is trying to assess the market potential for the product. Will it sell? Will it yield a good rate of return in the future? Innovative projects are risky, but they have the potential of high rates of return. For a start, there are no competitors. So no competitors means a monopoly position, which means they can charge a higher price. Venture capital investors will also be interested in team management. Look at the skills of the management team and their capability to create a profitable business. They want to know that their investment is in a safe, metaphorically, a safe pair of hands. They want to know that their investment is going to be dealt with responsibly by responsible people. And this is particularly true of high technology and innovative businesses who may be seen by some as a little strange in their procedures and the way to do things and the personalities involved. So the venture capitalists want to make sure that they're going to have a safe, their investment has a safe environment. It will be dealt with professionally. And they'll also look at the ownership of intellectual property rights. Successful ownership of intellectual property rights is attractive to venture capitalists. If there's a new product and it's protected, then in effect it has a monopoly position. No one else can start producing it. It is protected by the law. So intellectual property is very important to the venture capitalists. The size of the investment is a major factor. A high rate of return on a small investment will yield a sum that may deter the investment in the first place. So it depends really. If it's a small investment and there's a high rate of return required, if a high rate of return is required, then the sum that's required to generate it may be large, because it may need complete restructuring. The business may need setting up from the start, production, management, layout, plant. Everything may have to be put in place. So if a high rate of return is required, a large investment may be needed, and a given rate of return on a large investment is not as good as the same rate of return on a small investment. So the size of the investment is crucial. Generally speaking, the venture capitalists like to put in little and get a lot. Putting in a lot to get the same is not good. The cost of making a small investment is proportionally greater than a large investment. So, generally speaking, venture capitalists do prefer to have the large investments, but large investments that are secure and meet the criteria that we just talked about: good management team, intellectual property, and so on. Large investments that are likely to yield a steady return over a period of time, at least until the venture capitalist can sell their share in the business, capitalize that, and make a profit. But the point here is that generally speaking, venture capitalists are not interested in very small businesses. So a very small business who wishes to raise some investment, generally speaking, will not go for venture capital. These are players, investors who like larger investments that meet the criteria that we talked about earlier. So how to gain venture capital? A strong case based on evidence and research for likely profitability of the project, that would be good. A very strong case would be good. It should set out the strategic plans of the business and also the operational details that will enable an efficient business to function. It must explain why the business will be successful and convey what is unique about it. And it should also examine the basic assumptions of the business and enable milestones for future development. In other words, it should say, well, next year the business will be in this position, and the year after in this position. 5 years' time it will be in that position, so that the venture capitalist can look at the plan and get some sort of understanding of the direction the business is going to go in. The business plan should clearly show the commercial viability of the proposed venture and high growth potential. So the business plan should be attractive, but it should set out all of the important issues that are likely to be questioned by the venture capitalists. So it should cover marketing and competition strategy, production and distribution, personnel, and finance, budgeting, forecasting and cash flow. So it should cover all of the essentials. Generally speaking, a business plan, we could see it as made up from various components. An executive summary, a summary of the key features of the plan. It should start with that. It should, perhaps in 1 or 2 pages of A4, state the essential features of the business. With the market, it should state what the actual market is and what the potential market is likely to be, and what are the competitors. Who are the competitors? Who are the real competitors in the market today, and who are likely to enter the market tomorrow? So what is the market? What's the potential market? And what are the threats in that market? The uniqueness of the product should be emphasized. If it's an innovative firm, an innovative business, it's likely that the product will be different. It'll be perhaps new. And how does the business market the newness? How does the business market the product and emphasize the uniqueness of the product? And what's the potential of that product in the marketplace? Perhaps it's too unique, it's too innovative and won't be accepted. Intellectual property rights, legal protection for the idea, as I said at the outset, or a few slides back, intellectual property is ownership of the product. It's all of the technical specifications of the product or of the idea, and it is protected by law, so that for many years to come, the company will enjoy a monopoly position as a reward for it being innovative. That's why the legal system gives it this privilege. So protection of the idea through intellectual property rights is very important. What sort of marketing mix and what sort of channels for marketing? How should it be marketed? Should it be marketed on television or in the newspapers or magazines? And should it be marketed by advertisements or cutting price, or how should it be marketed? I mean, exactly what is the strategy? What's the best one for the product, and how is it going to be delivered? In terms of manufacturing, what's the technology? What skills are required? What training is required for staff? And what's the overall capital required? With sales and forecasting, what are the assumptions? It's easy to make everything look rosy with the forecast. It just means changing the assumptions, assuming the market will grow by 100% every year. Perhaps that's not realistic. Perhaps the market will grow by 5% every year. So it's important to make explicit what the assumptions are in forecasting. What's the organizational structure? How is management going to control the business? Is it a flat organization or is it a tall organization? How are the departments arranged and organized? Important. And the financing package should be clearly costed. It should be clear as to what everything is cost, and accurately done, so that, with evidence as well, so that the venture capitalists can see that the homework has been done, that the whole proposal is realistic and it's honest, it's open. So that is a backdrop on the role of venture capital and how to raise venture capital. And that also concludes this session. So thank you for watching. 1, 2, 3, 4. I hope this works, because this is a test 95.5. The last few didn't work, so let's see what's happening here.